हेलो फ्रेंड्स, गुड इवनिंग टू ऑल ऑफ यू एंड आज की इस वीडियो में बात करने वाले हैं हम मॉड्यूल सी एएफएम से रिलेटेड मोस्ट इंपॉर्टेंट कंसेप्चुअल पार्ट के बारे में। हमने एक लिस्ट क्रिएट करी है वेयर वी टॉक्ड अबाउट द डिफरेंट इंपॉर्टेंट पॉइंट्स की जो मॉड्यूल सी से सबसे ज्यादा इंपॉर्टेंट टॉपिक्स है उनकी हमने लिस्ट बनाई है। लगभग 35 टू 37 टॉपिक्स है विच आर वेरी मच इंपॉर्टेंट एंड डेफिनेटली आपको उसमें से एग्जाम देखने को मिलने वाला है। मेक श्योर कर लेना कि इस वीडियो को एंड तक जरूर गो थ्रू करना। और अगर आपको एएफएम का मॉड्यूल सी से रिलेटेड कंप्लीट पीडीएफ चाहिए तो आपको सिंपली लिखना है जेआईबी अपडेट और उसे व्हाट्सएप कर देना है टू द नंबर 8360944207। तो नंबर मैं आपको बता दे रहा हूं, इट इज 8360944207। सिंपली लिखेगा जेआईबी अपडेट और उसे व्हाट्सएप कर दीजिए एंड आई विल बी शेयरिंग द डिटेल्स विद यू। जल्दी से ऑडियो वीडियो क्वालिटी को कंफर्म कर दीजिए सो दैट वी कैन स्टार्ट। एंड आज का जो सबसे पहला टॉपिक हम स्टार्ट करने वाले हैं, जो हम गो थ्रू करेंगे, दैट इज गोइंग टू बी द रिस्क रिटर्न ट्रेड ऑफ। तो व्हाट इज रिस्क रिटर्न ट्रेड ऑफ, ईच एंड एवरीथिंग रिलेटेड टू इट विल बी कवरिंग। मेक श्योर टू आंसर एट द अर्लीस्ट। ठीक है, तो सभी टॉपिक्स काफी ज्यादा इंपॉर्टेंट होने वाले हैं। मेक श्योर कीजिएगा कि चैनल आप वीडियो को गो थ्रू करें एंड तक, राइट। चलिए, फर्स्ट पॉइंट इट्स रिलेटेड टू कि रिस्क रिटर्न ट्रेड ऑफ क्या होता है कि जहां पर रिस्क ज्यादा होगा डेफिनेटली वहां पर आपको रिटर्न भी ज्यादा ही मिलेगी। मोर इज द रिस्क, मोर इज द रिटर्न दैट यू विल बी गेटिंग। ये सिंपल सा फंडा होता है। रिस्क कह लो, वॉलेटिलिटी कह लो, ठीक है। अगर वॉलेटिलिटी भी ज्यादा है तो आपको रिटर्न भी ज्यादा ही मिलेगी। ये सबसे ज्यादा इंपॉर्टेंट पॉइंट है। एंड रिस्क क्या होता है? रिस्क होता है प्रोबेबिलिटी ऑफ लॉस। आपको किस चीज का एक लॉस की प्रोबेबिलिटी है, उसको हम रिस्क कहते हैं कि फायदा हो सकता है, नुकसान हो सकता है। दैट इज द प्रोबेबिलिटी ऑफ लॉस। एंड अगर रिस्क ज्यादा होगा तो रिटर्न भी आपको ज्यादा ही मिलेगी। एंड इसीलिए जो इन्वेस्टर्स हैं दे ट्राई टू डाइवर्सिफाई। अब कई बार ना क्वेश्चन में आपको टर्म आ सकती है कि डाइवर्सिफिकेशन क्या होती है। डाइवर्सिफिकेशन इज रिलेटेड टू कि आप मल्टीपल चीजों को ऐड ऑन करते हैं अपने पोर्टफोलियो में ताकि अपना ओवरऑल रिस्क जो है उसको आप कम कर पाओ, राइट। जैसे मान लो कि आप एफडी करवाते हो, ठीक है। अब सारी की सारी आप एफडी नहीं कराओगे, कुछ एक अमाउंट आप स्टॉक एक्सचेंज में इन्वेस्ट करोगे, कुछ एक अमाउंट के आप बॉन्ड्स या डेप्ट इंस्ट्रूमेंट्स परचेज कर सकते हो। दैट इज अबाउट व्हाट, दैट इज अबाउट द रिस्क एंड रिटर्न, ठीक है। तो प्रिंसिपल ऑफ रिस्क एंड रिटर्न यही इंफेसाइज करता है कि इन्वेस्टर्स जो हैं वो रिस्क एंड रिटर्न दोनों को कंसीडर करते हैं। किसी भी इन्वेस्टमेंट में अगर रिस्क ज्यादा है तो वहां पर रिटर्न भी ज्यादा होगी, और अगर रिस्क कम है तो वहां पर रिटर्न भी आपको कम ही मिलने वाली है। अच्छा, बॉन्ड्स के केस में रिस्क ज्यादा होता है या फिर लेट्स से गवर्नमेंट सिक्योरिटीज के केस में? तो सिंपल सी बात है दैट इन द केस ऑफ द इन द केस ऑफ द बॉन्ड्स, राइट, रिस्क इज मोर, वेयर इज इन द केस ऑफ द ट्रेजरी बिल्स और गवर्नमेंट बॉन्ड, जो गवर्नमेंट सिक्योरिटीज उनके केस में रिस्क कंपैरेटिवली कम होता है। फिर इसके बाद बात आती है रिलेटेड टू वेरी इंपॉर्टेंट पॉइंट्स, दैट्स अ थ्योरी, ठीक है। तो थ्योरी में क्या है, एक आपके पास एजेंसी थ्योरी है एंड द सेकंड वन इट्स रिलेटेड टू द स्टेक होल्डर थ्योरी, ठीक है। तो एजेंट क्या होता है? नाउ हु इज बेसिकली, एजेंसी क्या होती है? एजेंसी ना एक लीगल रिलेशनशिप होता है जहां पर एक पर्सन अपॉइंट करता है किसी दूसरे पर्सन को अपने बिहाफ पर ट्रांजैक्शंस को परफॉर्म करने के लिए, ठीक है। तो जो पर्सन अपॉइंट करता है उसको हम कहते हैं प्रिंसिपल, और जिस पर्सन को अपॉइंट किया जाता है दैट इज सेड टू बी एजेंट। उसको क्या कहा जाता है? उसको एजेंट कहा जाता है। तो एजेंट वो पर्सन होता है जो ट्रांजैक्शंस को प्रिंसिपल के बिहाफ पर करता है। अब एक प्रॉब्लम होती है, दैट्स द एजेंसी प्रॉब्लम, ठीक है। अब एजेंसी प्रॉब्लम क्या होती है कि जब एजेंट जो है वो बेस्ट इंटरेस्ट प्रिंसिपल के रिप्रेजेंट नहीं करते, और लेट्स से उसे हम क्या कहते हैं, वी से टू बी एजेंसी प्रॉब्लम, यानी कि कंफ्लिक्ट ऑफ इंटरेस्ट हो गया। जब पीपल जो है वो अपनी अथॉरिटी को मिसयूज करते हैं या लेट्स से अपने पर्सनल बेनिफिट के लिए इस्तेमाल करते हैं, तो दैट्स व्हाट, दैट्स अ एजेंसी प्रॉब्लम, राइट। और एजेंसी प्रॉब्लम में अलग अलग टाइप क्या हो सकती है, लाइक डिफरेंट टाइप ऑफ एजेंसी प्रॉब्लम कुड बी रिलेटेड टू शेयर होल्डर्स वर्सेज मैनेजमेंट, इट कुड बी रिलेटेड टू शेयर होल्डर्स वर्सेज क्रेडिटर, या फिर हो सकता है कि मेजोरिटी शेयर होल्डर की माइनॉरिटी शेयर होल्डर के साथ कोई दिक्कत हो, या शेयर होल्डर की अदर स्टेक होल्डर के साथ इश्यूज जो हो सकते हैं। दिस इज सेड टू बी व्हाट, इसको हम एजेंसी प्रॉब्लम के नाम से जानते हैं, राइट। दैट इज रिलेटेड टू द एजेंसी प्रॉब्लम, राइट। अब क्या आता है कि आपके पास अलग अलग थ्योरीज हैं कंफ्लिक्ट ऑफ इंटरेस्ट को लेकर के। वी आर हैविंग द डिफरेंट थ्योरीज, वी आर हैविंग द एजेंसी थ्योरी, वी आर हैविंग द स्टेक होल्डर थ्योरी। तो एजेंसी थ्योरी जो है वो कंफ्लिक्ट ऑफ इंटरेस्ट को एग्जामिन करती है, जो कि होते हैं बिकॉज जहां पर सेपरेशन होगी ओनरशिप एंड कंट्रोल के बीच में। लेट्स से ओनरशिप अलग है, इफ वी सी कि एक पार्ट पे ओनरशिप अलग है और दूसरे पार्ट पर जो कंट्रोल है वो अलग है। जब ओनरशिप एंड कंट्रोल अलग हो जाते हैं तो डेफिनेटली उसमें कंफ्लिक्ट ऑफ इंटरेस्ट हो सकता है, एंड ये एजेंसी थ्योरी उसी को एग्जामिन करती है। तो ये फोकस करती है कि जो रिलेशनशिप है प्रिंसिपल्स के बीच में और एजेंट के बीच में, उसके ऊपर फोकस करती है एंड देखता है कि कंफ्लिक्टिंग गोल क्या है और बेसिकली कौन से ऐसे इंसेंटिव्स हैं जो बेसिकली लीड कर सकते हैं कि भाई एजेंसी कंफ्लिक्ट हो जाएगा, राइट। दैट्स अ एजेंसी थ्योरी, उसको हम एजेंसी थ्योरी कहते हैं। इसी तरह से हमारे पास एक थ्योरी है दैट इज अ स्टेक होल्डर थ्योरी। नाउ स्टेक होल्डर थ्योरी क्या कंसीडर करती है, कंफ्लिक्ट ऑफ इंटरेस्ट को कंसीडर करती है, जो बेसिकली लेट्स से डिफरेंट जो स्टेक होल्डर्स हैं उनके कंपीटिंग इंटरेस्ट है। लाइक एक स्टेक होल्डर है वो चाहता है ऐसा होना चाहिए, दूसरा स्टेक होल्डर है वो चाहता है ऐसा होना चाहिए। अब जो दो इन दोनों पर्संस के बीच में शेयर होल्डर्स, एम्प्लॉयज, कस्टमर्स, सप्लायर्स जो सेम ही ऑर्गेनाइजेशन में है, उनमें जो कंफ्लिक्ट होता है उसको हम स्टेक होल्डर थ्योरी कहते हैं। तो ये बेसिकली क्या कहती है कि जो सभी स्टेक होल्डर्स है उनके नीड्स, उनके इंटरेस्ट, उनको बैलेंस करना है, राइट। उनके चीजों को बैलेंस करना है ताकि उनके बीच में कोई इश्यूज क्रिएट ना हो, सो दैट वी कैन अचीव द लॉन्ग टर्म सस्टेनेबिलिटी, दैट इज द मेजर पार्ट, राइट। सो दैट इज द केस रिलेटेड टू इट। अब उसके बाद हम बात करने वाले हैं रिलेटेड टू द नेक्स्ट चैप्टर। तो एक चैप्टर से मैंने आपको इंपॉर्टेंट चीजें बता दी, बाकी बेसिक पार्ट है कि टाइप ऑफ डिपॉजिटर्स क्या होते हैं, वो सब चीजें होती है, राइट। अभी हम नेक्स्ट जो पार्ट है उसके बारे में बात करने वाले हैं, दैट इज रिलेटेड टू द रेशियो एनालिसिस। अब रेशियोज तो बहुत सी हैं, लेकिन जो सबसे इंपॉर्टेंट रेशियोज हैं सबसे पहले हम उनके बारे में बात करेंगे, सो दैट यू कैन लर्न बेटर। तो फर्स्ट ऑफ ऑल इट्स रिलेटेड टू द करेंट रेशियो। नाउ करंट रेशियो होती है करंट एसेट्स डिवाइडेड बाय द करंट लायबिलिटीज। करंट एसेट्स डिवाइडेड बाय करंट लायबिलिटीज को हम क्या कहते हैं, वी से इट टू बी करंट रेशियो, राइट। एंड इसका जो ऑप्टिमम रेशियो होता है दैट इज 1.33:1। ये इसका ऑप्टिमम आइडल रेशियो कह लो, ये होता है 1.33:1 होता है। नाउ क्वेश्चन में दिक्कत कहां पे आती है एग्जाम में, वेयर दे आस्क यू कि भाई करंट एसेट्स कौन कौन से होते हैं। लाइक वी आर हैविंग द बुक रिसीवेबल्स हैं, अकाउंट रिसीवेबल्स हैं, बुक डेब्ट्स हैं, या ट्रेड डेटर्स है, या कैश है, बैंक बैंक बैलेंस है, राइट। ये सभी आपके क्या है, दीज ऑल आर दी करंट एसेट्स। वो सभी एसेट्स जो अगले 12 महीने के अंदर अंदर अपने फॉर्म को चेंज कर सकते हैं, उनको हम क्या कहते हैं, वी से देम टू बी द करंट एसेट्स। उनको हम करंट एसेट के नाम से जानते हैं। तो यहां पर भी वही सिनेरियो है कि करंट एसेट्स जो है वो चेंज कर सकते हैं। कौन कौन सी आपको मैंने बात बताई, लाइक कैश हो गया, वी आर हैविंग द बैंक बैलेंस, या फिर लेट्स से ट्रेड डेटर्स हैं, अकाउंट रिसीवेबल्स हैं, बिल रिसीवेबल्स हैं, इवन आपका स्टॉक हो गया, इन्वेंट्री स्टॉक जो मर्जी कह लो उसको, ठीक है। या फिर लेट्स से प्रीपेड एक्सपेंसेस आल्सो। नो प्रीपेड एक्सपेंसेस आर आल्सो व्हाट, दोज आर आल्सो योर करंट एसेट, वो भी करंट एसेट है। अब प्रीपेड एक्सपेंस एक्चुअल में होते क्या, व्हाट डू यू मीन बाय प्रीपेड एक्सपेंसेस। प्रीपेड एक्सपेंसेस होते हैं जो आपने खर्चा पहले ही कर दिया, यानी कि खर्चा बाद में करना था, ड्यू बाद में होना था, लेकिन आपने पहले कर दिया। उन सभी को हम क्या कहते हैं, वी से देम टू बी द प्रीपेड एक्सपेंसेस, राइट। अब वो आपका एक एसेट बन जाता है। लेट्स से आपने पूरे साल का रेंट पहले ही दिन अप्रैल के पे कर दिया, तो वो अगले 11 महीने का जो रेंट है वो भी ड्यू हुआ नहीं ना। जब ड्यू होगा तब उसको अपने खर्चे में शामिल करेंगे, तो आपका प्रीपेड एक्सपेंस वो बन जाएगा, वो भी आपका करंट एसेट का पार्ट होता है। सो इसी तरह से करंट लाइबिलिटीज होती हैं, लाइक आपने सीसी लिमिट उठा रखी है, ओवरड्राफ्ट लिमिट है, या ट्रेड आपके क्रेडिटर्स हैं, या आपके बिल पेएबल हैं, ठीक है। तो वो सभी क्या हो जाएंगे, दोज ऑल विल बी योर करंट लाइबिलिटीज। वो सभी आपकी क्या बन जाएंगी, करंट लाइबिलिटीज बन जाएंगी। आप उनको कैलकुलेट कर लोगे एंड दैट विल बी द पार्ट रिलेटेड टू इट, ठीक है। तो आप उस तरह से सॉल्यूशन फाइंड आउट कर लोगे। सो दिस इज हाउ बेसिकली द करंट रेशियो वर्क्स। एंड आइडल रेशियो क्या रहती है, आइडल रेशियो इज 1.33:1, सिंपल सा फंडा। अब दूसरा जो एक फॉर्म है दैट इज अ क्विक रेशियो। ना क्विक रेशियो या फिर एसिड टेस्ट रेशियो भी इसको हम कहते हैं, दिस इज क्विक एसेट्स डिवाइडेड बाय द करंट लायबिलिटीज। ना क्विक एसेट के केस में कुछ एक चीजें शामिल नहीं होती, वैसे होते ये करंट एसेट्स ही हैं, लेकिन आप सबसे ज्यादा लिक्विड जो एसेट्स होते हैं ना उनको क्विक एसेट कहते हो। आप इसमें स्टॉक को शामिल नहीं करते, आप प्रीपेड एक्सपेंसेस को शामिल नहीं करते, दैट इज योर क्विक एसेट। वो आपके क्विक एसेट होते हैं, बाकी करंट लायबिलिटीज आपके वही होते हैं। एंड इसकी जो आइडल रेशियो होती है दैट इज 1:1, दैट इज 1:1। अच्छा, अगर किसी कंपनी के केस में जो करंट रेशियो है इफ इट इज लेसर देन 1, तो उसका क्या मतलब होएगा? व्हाट डज इट विल इंडिकेट? क्या चीज इंडिकेट करेगी? Now let's say if you are having the current ratio lesser than 1, तो क्या चीज इंडिकेट होगी? कि आपकी लिक्विडिटी बिल्कुल भी नहीं है और आपको शॉर्ट टर्म बोरिंग करनी पड़ेगी अपने डे टू डे एक्सपेंसेस को चलाने के लिए, क्योंकि आपके पास पैसा नहीं है। क्योंकि करंट रेशियो लेसर देन 1 तभी होगी व्हेन योर करंट लाइबिलिटीज विल बी एक्सीडिंग योर करंट एसेट्स, and when your current liabilities are exceeding your current asset, it is basically a horrible situation, and you are to borrow money for the short term duration so that you can make up your expenses, right? So that's the point. So this is the major difference between the this is the current ratio. And what is the major difference between the current ratio and the quick ratio? The current ratio includes all the current assets, whereas in the case of the quick ratio, we just do cover the current assets which are liquidifiable easily. Like stock is not liquidifiable easily. Like prepaid expenses cannot be liquidified at all because those have already happened, right? So that we basically exclude from the current assets, and the others do represent what? Others do represent the quick asset, and this is how we do calculate the quick ratio. So quick ratio, ideal ratio is 1:1, whereas in the case of the current assets, current ratio, it is 1.33:1. Further, we are going to cover the next ratio, that is a debt service coverage ratio, that is a DSCR. Now, what do you mean by DSCR? DSCR is debt service coverage ratio. Now, what is DSCR? DSCR is debt service coverage ratio. So, whensoever the banks are to lend money to the firms, to the corporates for the term loan purposes, they do calculate this ratio, that is the DSCR. Now, if this ratio is higher, then we say it's a good thing. But if its ratio is lower than 1, we say it's not basically eligible. The party is not eligible for the loan because they cannot service the loan. So this ratio determines either are we in the position to service our loan or not, right? So that is the case. So in numerator, we are having what? We are having the profit. We are having the profits that we are having. So it is a net profit that we are having, and in the denominator we basically take the term that we need to pay, like let's say annual installment and interest. So in denominator we are having annual interest and installment, and in numerator we are in the net income, right? So what's the formula related to the DSCR? The DSCR formula is very simple. It is profit after tax plus depreciation, that is a non-cash expense, plus annual interest. In numerator, we are having these terms divided by annual interest plus installment, annual installment. This is how we can calculate the DSCR. And the ideal ratio for the DSCR is 2:1. The ideal ratio for DSCR is 2:1. Clear? Kindly do let me know at the earliest. Kindly do answer at the earliest. Are we clear with this point? So DSCR वो रेशो है जिससे हम ये पता लगाते हैं कि क्या इस फर्म को पैसा हम दे सकते हैं या नहीं दे सकते, उसके बारे में, राइट? नाउ लेट्स मूव टू द अनदर इंपॉर्टेंट रेशियो. द अनदर इंपॉर्टेंट रेशियो इज द डेब्ट इक्विटी रेशियो. Now, debt equity ratio tells us about the financial leverage of the company. The more the ratio is, it means the more highly leveraged the company is. So, in the case of DSCR, higher the ratio is the better one. But in the case of the debt equity ratio, lower would be better one. Because in case of DER, it's equal to what? It's equal to long-term liabilities divided by the tangible net worth. Formula is long-term liability divided by the tangible net worth. Or we can simply say that's equal to the debt to equity ratio. It is debt to equity ratio. Okay, so it is debt to equity ratio, or we can say it is long-term liabilities to the tangible net worth, and lesser the ratio, better it is. If the company XYZ is having the debt equity ratio of 5, and the company ABC is having the debt equity ratio 2, so we will be considering that the company ABC is in a better position. Company ABC is in a better position. So higher the ratio is, more the leverage is, lower the ratio is, lesser the leverage is. So we'll be considering that the lower ratio would be much better. So in that scenario, we'll be considering that the lower ratio is much better, right? Now, after that, it's the profitability ratio. Now, the one ratio we are having over here is a gross profitability ratio, and the other one it is a net profit ratio. Now, gross profit ratio क्या बताती है हमें? ग्रॉस प्रॉफिट रेशियो बताती है कि हमारी प्रोडक्शन एफिशिएंसी क्या है. व्हाट इज अवर प्रोडक्शन एफिशिएंसी? कि जो बिजनेस है, वन बिजनेस इज हाउ मच एफिशिएंटली बिजनेस इज प्रोड्यूसिंग द गुड्स और सर्विसेज in relation to the sales. That is your gross profit ratio. So gross profit divided by the sales, net sales, that is your gross profit ratio. And when we're talking about the net profit, and in the scenario where we are talking about the net profit, what does that indicate? It basically says it measures the overall profitability after all the expenses, interest and taxes have been deducted. So जब हमने सभी अपने एक्सपेंसेस, इंटरेस्ट, टैक्सेस को डिडक्ट कर लिया है, उसके बाद हमारी प्रॉफिटेबिलिटी क्या उसके बारे में बताती है. सो इन वन पॉइंट वी आर हैविंग द नेट प्रॉफिट, एंड इन द अदर वी आर हैविंग द ग्रॉस प्रॉफिट. In the other we are having the gross profit. So gross profit ratio, in case of gross profit ratio, we do focus on production and trading efficiency, right? But in case of the net profit ratio, we do consider the overall let's say profitability after all the expenses in case of the net profit ratio. And what about the expenses that we consider? In case of gross profit ratio, we do consider only the direct expenses. In this scenario, we do consider the direct expenses only, right? Because we do consider the COGS only, that is the cost of goods sold only. But in the case of the net profit ratio, we do consider all the expenses, whether those are admin expenses, selling expenses, interest expenses, right, or taxes. We do consider all the expenses in the case of the net profit ratio, right? So the gross profit ratio is indicator of what? It is an indicator of operational efficiency. It is indicator of the operational efficiency, whereas in the case of the net profit ratio, it is an indicator of the overall financial performance. It is indicator of the overall financial performance. Are we clear? Right? So that is the case related to it. Now, after that, it is a ROI versus the ROCE. Now, one, it is related to return on investment, and on the other hand, we are having the return on capital employed. So what do you mean by ROI? ROI is basically net profit to total investment. That is your ROI, return on investment. Return on investment. So basically, in case of the ROI, we do measure how much profit that we have earned from the total money that we have invested in the project. In the total money that we have invested in a project, we are talking about the equity over there, right? So what amount we basically uh, given in the project, and what amount we have earned over it, that is our ROI. So in case of ROI, it means that, and but when we're talking about ROCE, it means the total capital that we have employed. So total assets minus the current liabilities is the total capital that you have employed, right? And further, that will be indicating what? That will be indicating your ROCE. So in case of ROCE, we do consider the debt component also. Whereas in the case of the ROI, we do consider the equity component only in the denominator component I'm talking about, right? So ROCE basically indicated how efficiently the company is using its long-term funds, whether it will be equity fund or the debt fund, so as to generate the profit before financing, before the financing cost and the taxes, right? So that is your ROCE. So ROCE formula is quite simple. It is EBIT, that is earning before interest and tax, divided by the capital employed, right? That is your ROCE. That is a return on capital employed. Clear? So what is the major difference between the ROI and the ROCE? ROI basically considers the profitability related to a specific investment or project. So it is specific. So ROI is specific one, right? Whereas in case of ROCE, it is a overall efficiency. It is a overall efficiency, that what's of the debt component we are having, what's of the equity component we are having, what we are earning over it. That's your ROCE, right? And what is the formula? Formula is net profit to total investment in case of the ROI, and in case of ROCE, it is EBIT divided by the equity plus long-term debt, right? So the scope of ROI is narrow, whereas in the scope of the ROC is broader one, right? Is that clear? And ROI is calculated after interest and tax. It is calculated, it is very important, calculated after interest and tax. Whereas in the case of ROCE, we do calculate it before interest and tax. Calculate it before the interest and tax, we do calculate the ROCE, right? Now, the next one, it is the working capital management. Now, what do you mean by the working capital management? Acha, first of all, do let me know about what is working capital. We are having the current assets, we are in the current liabilities. So whatsoever the component which is exceeding of the current asset, which is exceeding over the current liabilities, that is your working capital. So if I'm having the current assets minus the current liabilities, that is your net working capital. We simply say it is working capital. And what is your gross working capital? The total of the current assets is your gross working capital. That is your gross working capital, right? So gross working capital is the total current assets. Net working capital is the current assets minus the current liabilities. And what is your permanent working capital? Like minimum level of the working capital which is required all of the times. That is your permanent working capital. That is your permanent working capital. And we are having just two components in case of working capital. One, it is the current assets. Other one, it is the current liabilities. In current asset, as I told you earlier, cash, bank balance, trade receivables, short-term investments, debtors, stock, prepaid expenses, right? These are your current assets. Whereas in the case of the current liabilities, it's creditors, bill payables, trade creditors, outstanding expenses, short-term borrowings like CC limit, OD limit, etc., and accrued liabilities, whatsoever you're having. Those are your current liabilities, right? And what is the major purpose? Why do we want to manage the working capital? Because we want to stabilize the adequate liquidity, first of all. We want to optimize the profitability, like we want to minimize the cost of funds, right? That's the main thing. And what is the working capital cycle? Very important point. What is working capital cycle? Let's take the case that we had the cash. We had the cash, right? And we started from here only. So we had the cash, we purchased the raw material, we processed it, and the goods were formed, and further we sold it. The sales were there. Some of them were sold directly and we had the cash, right? And in some of the cases, we offered the credit period. Let's say credit period of 30 days were offered. So then it was converted into cash. Now the whole cycle, which took the time from generating the cash from the cash itself and further till the cash is generated, that is your working capital cycle or operating cycle. Now, longer the working capital cycle or the operating cycle is, more is the working capital requirement. Let's say the case one firm is having the working capital cycle of 2 months and the other one is having the working capital cycle of 1 month. Now, which one would be the better one? Which one would be having the lesser requirement for the working capital? Definitely the firm which is having the operating cycle of 1 month, that will be requiring the lesser amount of the funds as working capital, because lesser funds would be required for day-to-day management purposes, right? So that is a working capital cycle. And we are having the different methods for the calculation of the working capital, for assessing the working capital. Like we are in the Tandon committee method 1, MPBF method 1, method 2, NAC committee method, or let's say turnover method we say. So that's the method. And we are going to learn each and everything about it. Like what is a NAC committee method, what is MPBF 1, MPBF 2, very much important. Other than that, we are having the cash CBM method also. That is a cash budget method also. That's also important, right? So starting with the first one, that is the NAC committee method we are going to read about first of all. So it is a annual turnover method, projected annual turnover method, or simply PATO we can say. It is projected annual turnover method or the Nayak committee method. Now, in this case of solving the point related to the working capital, that what amount of working capital is required, it's very much simple. First of all, we just, as per this method, this is assumed that the industry or the company will be having 4 operating cycles or working capital cycles in 1 year, right? So let's say the case, this circle is representing the complete 1 year, and we just assume that the company is having 4 operating cycles. This is the operating working capital cycle 1, 2, 3, and 4, right? And it will be considering whatsoever the total turnover is, the maximum capital, or let's say the gross working capital which is required in every of each of the quarter, that is 25%. For each quarter, we require 25% of the total capital. So 25% of the capital is required each and every quarter, right? So the gross working capital requirement would be what? The total turnover multiplied by 25%. So let's assume a company is having the gross working is company is having the total turnover of let's say 20 lakh. 20 lakh is a turnover. 20 lakh is a turnover, right? So what amount will be required as a gross percentage? It is into 25%. So it is 5 lakh. 5 lakh would be the maximum working capital which is required. But the NAC committee method says that the 5% margin is to be maintained. That 5% margin is to be maintained, right? So in that scenario, we'll be subtracting 5% of 20 lakh. So minus 5%, that will be what? That 25% minus 5%, that is equal to 20%. So the maximum permissible finance as per the NAI committee method, it will be 20% of the turnover. So 20% of 20 lakh means 4 lakh rupees. So this amount would be sanctioned. And this is favorable for the small units who are having the turnover lesser than or equal to 5 crore rupees. This is favorable in that scenario. So that's about the Nayak committee method. Clear? That is about the Nayak committee method. And other than that, the second method that we are going to learn about, it is a MPBF1. It is a MPBF1. That is maximum permissible bank finance method. And this is given by Tandon committee. Now we are going to learn about the Tandon committee method. Now, Tandon committee basically gave 3 methods: MPBF1, MPBF2, MPBF3. Now, MPBF3 was rejected, so we don't consider it because it was rejected by Reserve Bank of India. We do consider 2 major points. One is related to the MPBF1, other one is the MPBF2, right? So, in case of the MPBF1, we do consider that WCG is the working capital gap. That is the finance that is required, right? So first of all, it is a MPBF1 by Tandon committee. So what we need to solve? We need to solve the working capital gap. Now, what do you mean by working capital gap? So let me just give you background. First of all, the Tandon committee was formed by the Reserve Bank of India only, right? And the basic concept is related to what? That working capital gap is there. In case of MPBF1, we are having the working capital gap. And out of working capital gap, the margin of 25% working capital gap is to be maintained. Minus 25% of the working capital gap. This is a MPBF method 1. Now, what is working capital gap? Now, let's take a case that we are having the total current assets on one side. We are having the total current liabilities on the other side. I'm talking about the current assets and the current liabilities, right? So, the total current assets minus, or we can say simply current assets minus the current liabilities other than bank borrowings. Current liabilities other than bank borrowings, that will be your working capital gap. That will give you working capital gap. And this is the formula that we need to apply. That is working capital gap minus 25% of the WCG. And that will be what? That will be your MPBF method 1. That will be your MPBF method 1. And what about the method 2? What about the method 2? In case of method 2, the margin is to be subtracted from the margins to be taken from the total current assets. Now, in the first scenario, the MPBF 1 is maximum permissible bank finance 1 is WCG minus the 25% of the WCG. Whereas in the case of the method 2, the maximum permissible bank finance would be equal to what? It will be equal to WCG minus 25% of the total current assets. That is your MPBF as per the method 2. Now, interesting point is that in case of the method 1, the minimum ratio, current ratio, which is maintained, the minimum current ratio, which is maintained always and always, it is maintained 1.17 is to 1. That will always be maintained. But in case of the MPBF method 2, the minimum current ratio which is maintained, it is 1.33 is to 1. It means more stringent ratio is being maintained in case of the method 2. More stringent method is being the method 2 over here, right? Okay, so that will be related to the method 1 and method 2. Clear? Now, after that, it's related to the compound interest. It's related to the chapter for the interest and annuities, right? So we are having the compound interest with us. Now, what is compound interest? One, it is a simple interest. The simple interest is P into R into T. For R, 100 will be there, and for time conversion, right? We'll be considering what? That's a simple formula about the simple interest, right? P into R into T divided by 100. And for compound interest, the interest is also calculated upon the accumulated interest, right? For simple interest, the interest is calculated on the principal value only. But in the case of the compounding interest, you earn the interest over the accumulated interest also, right? So that's the compounding interest. Compounding interest formula is quite simple. That is A is equal to P into 1 plus P into 1 plus R raised to power n. Now, if the compounding is done on half yearly basis, what will be the formula? If it is being done on half yearly basis, then it will be equal to P 1 plus R divided by 2 and 2n. That will be the formula. If the compounding is being done on, let's say, half yearly basis or quarterly basis, if half yearly compounded, if quarterly compounded, then it will be P into 1 plus R divided by 4 and 4n, right? So this is how we do calculate. Now let me just quote a question to you. Now let's assume that a town is having, let me draw the timeline for you. Here it is 0, right? And this is 5 years from now, and it is 3 years ago. And we are talking about the population for now. We are talking about the population. So if we say that right now we are having the population of 10 million, or let's say we are having the population of 1 million. This is the present population we are having, and the population is increasing at 8% per annum. It is increasing, compounding at 8% per annum. So what will be the population that will be having 5 years from now, right? So we are to use a formula, that is A is equal to P into 1 plus R raised to power n. So what is the P value? P is 10 lakh, and 1 plus R, that is 8 divided by 100. So as to convert it into decimal component, and raised to power n means 5, n would be equal to 5 number of years. Now we can simply solve it. So it will be 1.08 raised to power 5. So how will we be solving 1.08 raised to power 5? You have to write 1.08 in the simple calculator. multiply sign 1.08 again. Now press the equal to sign for 4 times. 1, 2, 3, 4. It is 1.46932. So multiply by 10 lakh. That is 14 lakh. The answer is 14 lakh 69,328. This much population that we'll be having after 5 years if it is increasing, if it is compounding at 8% per annum. If it is compounding at 8% per annum. And what about if we are to calculate the population 3 years ago? How we'll be able to calculate if we are to calculate population 3 years ago? Now, in that scenario, we'll be considering this particular point, that the population future, that is, this value will be considering as A, and we'll be considering this value as P. Now you can solve it easily. So what I mean, I'll be writing the same formula. A is equal to P into 1 plus R raised to power n. Now, the value of P we need to calculate, and A is the value that we are already having. So A is 10 lakh that we are already having, and P, that is a present value. We consider the last value as the present value, right? That we want to calculate. So 1 plus R means 1 plus 8 divided by 100 and raised to power 3. Now you can be solving it easily and you can mark your answer. Clear? Now there is a rule of 72. Rule of 72. Now let's say case if I'm earning 6% interest rate, right? Compounded annually. In how many years lump sum my amount will be doubled? In how many years lump sum my amount will be doubled? Just do answer at earliest. We are talking about rule of 72, right? So kindly do answer at the earliest. So it's very easy. It's 72 divided by the percentage. Almost 12 years it will take to double the amount. But it is applicable for the compounding interest only, not for the simple interest. Clear? Now, let's move further. It's about the annuities. Very important. Very important. Now we'll be learning a few concepts about the annuities from here. The first concept that we are to learn, it's about the what is annuity. The second about ordinary annuity and annuity due, right? And the time value of money, right? For the sinking fund. And further in time value of money, we will be knowing about present value and the future value, right? And bonus tip, we'll be learning about the EMI, equated money installment. Okay. So starting with annuity. So let's just simply start with annuity. Let me just give you an example of annuity first of all. Let's take the case that you are paying a rent of 20,000 per month in the beginning of the month. Per month in the beginning of the month for the next of your 1 year or 2 years every month. Now fixed amount is being paid. First of all, a fixed amount is being paid. Second thing, the amount is being paid at regular intervals. Like I'm paying the amount monthly basis. So that forms what? That forms an annuity. That is forming a annuity. That is what we say to be annuity. Now, why we are basically interested in calculating the annuity? Because let's take the case that I'm paying the installment for my loan. I'm paying the EMI for the loan. I'm paying the amount each and every month at the end of the tenor, right? Let's say for every quarter I'm paying the EMI, or let's say for every month I'm paying the EMI. Now I'm interested that what is the present value of the EMIs that I'm going to pay, or let's say what would be the future value of the EMIs I would be paying, right? So if I have taken a home loan of let's say for 20 years and I'm paying the amount on each and every month, what will be the present value of the whole amount that I'm going to pay, and what amount I'm getting right now today, right? So this concept is very much important to understand. So annuity is a series of the equal payments or receipts at regular intervals. It could be monthly, quarterly, half yearly, annually, right? It could be anything. Examples I've already told you. It could be the EMI, it could be the systematic investment plan, it could be the pension payment, it could be the insurance payment, premium payment, it could be anything. And it is of two types. We are having ordinary annuity. One, it is a ordinary annuity. In case of the ordinary annuity, the payment is being made. The payment is being made or being received at the end of the period. At the end of the period, like loan EMI, interest payments, that is your ordinary annuity. That is your ordinary annuity, right? So I'm drawing the timeline over here. So this is 0, that is today, 1, 2, 3, 4. So if I'm paying a amount of rupees 10,000 at the end of each year, that is forming what, that is basically a ordinary annuity. So I'm paying 10,000 here, 10,000 here, 10,000 here, 10,000 here. That is ordinary annuity, right? And the second concept, it's related to the annuity due. Now, annuity due is also an annuity, but here I'm going to pay the amount or receive the amount at the beginning of the period. At the beginning of the period, I'm going to receive the amount, right? Or I'm going to pay the amount. Let's say, take the case like uh, rent, or let's say the case insurance premium. So this is 0, 1, 2, 3, 4. So I'm going to pay the amount here, 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 here. No, what was the difference majorly? What was the major difference? The major difference is, let's say if the interest is applicable, I'm earning interest here, 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 and here. For 4 years, I earned interest for 4 years. Whereas in the case of the ordinary annuity, I earned the interest just for 3 years. Or I paid the interest just for 3 years and not for the 4 blocks, right? That is a difference between the annuity, ordinary annuity, and the annuity due, right? So one, it's related to the payment structure, that you be basically been paying the amount or receiving the amount at the end of the tenure, then it's ordinary annuity. If it's in the beginning of the term, then it's the annuity due, right? Now, let's learn about the concept of time value of money. Now, if I'm having rupees 25 lakh today in my account, it is valuing more. Or if I'm having 25 lakh rupees 5 years from now, that will be valuing more. Which amount will be valuing more? Amount today or amount after some time, or amount in future? Definitely, what value I'm having today in my pocket is value more than the amount that I'll be having in the future, if the same value is being considered, right? So that basically showcases what? That showcases the time value of money. And why it is there? Why it is there? Because the value might depreciate, there might be inflation, right? There are so many causes about it, right? So that is the time value of money. That's why we are interested that whatsoever the amount that we are going to invest, like in this scenario only, if I'm giving 10,000, I want to calculate that the amount after paying, after 1 year that I'll be paying, what will be value in today time, this value, what will be the value in today time? Or it in the case that I'm interested in the future value, that what amount this will value will be carrying in the future, right? That is basically the present value. If I'm going to calculate the all value of all the cash flows for today only, and if I want to calculate the value the cash flows in near future, right, then basically that will be the future value. Then that will be the future value, right? So there are two values for ordinary annuity also, and also for the annuity due. We are having the two values: future value of the ordinary annuity, present value of the ordinary annuity, and same thing, right? Now, I'm giving you four formulas from one single formula that you need to cram or need to memorize, right? So the first formula is future value of the ordinary annuity. Future value of the ordinary annuity. It is C into 1 plus I raised to power n minus 1 divided by I. As simple as that. This is a let's master formula that you need to memorize, right? One formula, and you can memorize five formulas easily. So you need to memorize this formula, that C into 1 plus I raised to power n minus 1 divided by I. Now, I is the interest rate that will be applicable on the amount. Let's say 8% interest you're earning each and every year, right? So that will be the interest rate, right? And N is a tenor. N is the tenor. And C is the cash flow. When I'm saying the cash flow, it may be the cash inflow, it may be the cash outflow, right? So let's apply this formula. So let's take a case that I'm going to pay rupees 10,000. I'm going to pay rupees 10,000 for each and every year for next 5 years. So rupees 10,000 for 5 years, and let's say interest rate I'm earning is 10% per annum. So what will be the future value? So whenever in the question there is nothing mentioned that you're going to receive the amount or pay the amount at the end of the tenor, you'll be considering that it is ordinary annuity, right? You'll always be considering that it's a case of the ordinary annuity. So it will be C will be 10,000. I'm just putting the values, and 1 plus I would be 10%. In decimal, it will be 0.10. So 1 plus 0.10, that is 1.1. 1.10 raised to power 5 because it is for 5 years minus 1 divided by I, that is 0.10, right? This is what I need to solve right now. So again, as I told you, 1.1 multiplied by 1.1 and raised to power 5. So I'll be pressing equal to sign for 4 times. 1, 2, 3, 4. Minus 1 divided by zero point 0.1 multiplied by 10,000, and that's my answer. So the future value would be 61,051. It will be 61,051 rupees, right? Kindly make sure that you are having the pen copy with you and simple calculator with you so that you can be solving the questions along with me. Right? So this is the first formula that you have learned. I'm just marking it as 1. Now, the second formula is from the annuity due. Like if you have to calculate the future value of the annuity due, future value of the annuity due, where you are going to deposit the money at the beginning of the period. Same question statement I'm taking. I'm going to take the same question statement. Rupees 10,000 for 5 years and at 10% per annum at the beginning of the period. For this case, it will be specifically be mentioned in the question that it's an annuity due or the amount is being deposited at the beginning of the period, right? It will be specifically being mentioned. So what is the formula? Very simple. Future value of annuity due is equal to C into 1 plus I raised to power n minus 1 divided by I. Now you'll be saying that you just replicated the formula. It's the same formula that you have written above. Yes, it is the same formula. But there is one extra term each and every time for the annuity due. That is 1 plus I. This would be the extra term that we'll be using. Kindly please memorize that this is the extra term that we'll be using. That's it. Everything else will be all same. So I'm going to now solve this particular question. So it is 10,000. 1 plus I, that is 1.1 raised to power 5 minus 1 divided by 0.1 and 1.1. That's it. That we need to solve. So I have already calculated 61051 multiplied by 1.1. That's it. It is, my answer is 67156. This will be the future value for the, this will be the future value for the annuity due. Clear? Are you clear with this point? Yes, this would only be the English language lecture today. Are you clear with this point? Okay. Now, we'll be solving the present value for the ordinary annuity. Now, same formula again. So that was the second formula. Let me just mark this formula for you. This is the second formula that you learned. So this is the second formula that we have learned. Now we'll be learning the third formula. And the third formula is related to the present value of the ordinary annuity. Now we'll be writing the same formula. C into 1 plus I. Because in the case of when we are to calculate the present value, na, we say I to be R. R is the discounting rate because we have to discount the value. Interest is that you earn about something, and discount is when you discount the value, let's say we downgrade the value to some point, right? That's a discounting value. So we replace I with R. So it is R raised to power n minus 1 divided by R. Just one simple change to it. You'll be adding the same term as in the numerator to the denominator. That is 1 plus R raised to power n. That's it. And this is your third formula. That is a present value of the ordinary annuity. Are we clear? So this is the third formula that you learned from here. Now, if we are to calculate, what will be the answer? It is 10,000 into 1 plus R, that is 1.1 raised to power 5 minus 1, and 0.1 multiplied by 1.1 raised to power 5. That's it. That's it. That's what we need to calculate. So it is 1.1 raised to power 5. So 1.1 multiplied by 1.1. So it is 1.61051. 1.61051. So the present value for the same amount that you're going to deposit each and every month for the next 5 years, the present value is 37,907. This is a present value. This is a present value, right? And now it's the time for the fourth formula. The fourth one, simply do write the same formula as our second one. What was it? We have to calculate the present value of the annuity due. So it is C into 1 plus R. I is replaced by R raised to power n minus 1 divided by R and 1 plus R. Just one simple change, add the numerator term back to the denominator. That is 1 plus R raised to power n. That's it. And now you can easily solve the present value of the annuity due. Clear? So this is what we need to solve. And these are the four formulas. And this is all about the annuities. That's it. One more topic that we'll be learning here that I never mentioned. Oh, sorry, I have mentioned already. It's a sinking fund. So far we have learned about the annuity, that what the annuity is. We have learned about the ordinary annuity, annuity due. We have learned about the time value of money, right? We have learned about the present value, future value, and now we are going to learn about the sinking fund. Now let's take the case that I want to create a fund and I want to put aside money for the same so that I can be having a fixed amount at the end of the tenor, right? Let's say case I wish to buy a car 5 years from now and I want to buy a car worth rupees 25 lakh rupees, right? I know that I need at least 25 lakh rupees from 5 years from now, right? So what amount I'm going to deposit each and every month or each and every year, that is sinking fund. So let me just write, it's about the sinking fund. So let's take the same example, that 0, 1, 2, 3, 4, and 5. And I need 25 lakh from today so as to buy a car. So as to buy the car. Alright. So what amount I'm going to deposit each and every year. So let's take the case that interest is applicable at 12% per annum. Right. And I'm to calculate the amount. So what value I'll be calculating? And it is never mentioned in the question that it's a at the in the beginning of the period or at the end of the tenor I'm to deposit. So I can be considering ordinary annuity case. Now just tell me that what value I'm to calculate. I'll be calculating the future value or the present value. Kindly do answer. For ordinary annuity, I'll be solving using the formula for the future value or the present value. I'll be solving using the future value formula. Why? Because we are having the future value with us, right? Simple as that. So this is a future value, na? This is the future value. So we'll be solving using the future value only. So what was the formula for the future value of ordinary annuity? Simple. C into 1 plus I raised to power n minus 1 divided by I. So we can solve it easily. So C is what we need to calculate because we need to calculate the cash flow, right? And I is given to be 12%. So it is 1.12 raised to power 5 minus 1 divided by 0.12. And you have the future value as 25 lakh. This is the future value that we are having. We have to calculate the this particular term only. And so as to divide it on the other side. That's it. So 1.12. So this is 6.3528. That is, we are to deposit 3,93,527 rupees each and every year. Now this amount is to be deposited. This amount is to be deposited at 12% per annum each and every year at the end of the tenure, so that we can be having a fixed amount of rupees 25 lakh at the end of 5 years. Are we clear? So this is how the sinking fund works, right? Now, let's solve one question more, and it's a bonus point because we are going to solve it about the EMI. Now, EMIs are the example of what type of annuity? These are the examples of the ordinary annuity. EMI is the example of the ordinary annuity, right? Can we solve it? Yes, we can easily be solving it. So if we are considering the case of the loan, we are having the months on monthly basis we pay the EMI, na? So it is zero, first month, second, third, fourth, and so on. Let's say the case that I took a loan for 6 months and I took a loan amount of rupees 10,000. I took the loan amount today only. So this value is what? This value is the present value I'm having today. So loan amount is the present value of the amount, loan amount. This is a loan amount, 10,000 rupees. And this is a present value. I took it today, na? So it's a present value. And I'm to pay the installment each and every month. Now that is going to be EMI that I'm going to pay. Easy to solve? Yes, easy to solve. What formula I'll be calculating? I'll be calculating the present value of ordinary annuity formula. Just applying that. Present value ordinary annuity formula. C into 1 plus R because it's present value raised to power n minus 1 divided by R, and one more term for the present value 1 plus R raised to power n. That's it. That you need to solve. And here C would be what? C would be the EMI that we need to solve, and PVOA would be the loan amount. This is a loan amount. Clear? Let's solve this. Let's say a case that the interest rate is 12% per annum. Interest rate is 12% per annum. Let's solve this question. Now loan amount is rupees 10,000. So it will be 10,000. EMI we need to solve 1 plus R. Now R would be what? R is 12% per annum. We have to convert it on monthly basis. So 12% divided by 12, that is 1% per month. And for N would be equal to what? 6 months. So N will be equal to 6. N would be equal to 6. If it was 1 year, it would be 12, right? Because we were to convert it for monthly basis. So 1 plus 1%, that is 0.01. So it will be 1.01 raised to power 6 minus 1 divided by 0.01, and 1.01 raised to power 6. That we need to solve, right? That we need to solve now. So it will be 1.01. So it is rupees 1725.50. So this amount I'm to pay approximately each and every month for the next 6 months so as to repay my loan amount of rupees 10,000. Right? So we learned many concepts. We learned about the annuity, we learned about the types of annuity, we learned about the present value, future value, we learned about the sinking fund, we learned about the EMIs also. Right? So that was about the interest and annuity chapter. Are we clear? So we have learned each and everything about it. We have learned about the EMIs also, that how to solve the EMIs and everything. We have learned about that also. Now, let's move further and learn about the bonds. Now, bond is what actually? Bond is a debt instrument. What is a bond? Bond is a debt instrument, right? So let's say the case company XYZ is there and it wants to raise the fund. Now, how it can be done? Either way, it can take a loan from the bank, like term loan can be taken, it can take CC limit, or it can take overdraft limit, or it can be issuing the equity by way of equity also, or, or it can be issuing the debt instrument. Debt instruments like debentures, bonds, etc. It can be issuing that also, right? So these all different things can be done, right? So that will be what? That will be like a debt instrument. So bond is a debt instrument where the issuer will be having an obligation so as to repay the amount at the end of the maturity. Getting it? So let's say the case that the company XYZ issued a bond which is having a face value of rupees 100. I will be making you explain each and everything what it is, right? Rupees 100 is a face value. Rupees 100 is a face value and it is being issued for 5 years. And coupon rate is 10%. Coupon rate is basically the interest payment, right? And the coupon rate is always calculated on the face value. Always calculated on the face value, right? So what will be the timeline? What will be the timeline? So in timeline, we'll be having something like this. Let's say this is the timeline. This is 0, 1, 2, 3, 4, and 5 years, right? So here is the present value, that is 100 rupees, and that we paid, that is a cash outflow, not the inflow, right? And what the person will be earning? Person will be earning this coupon 10%, and calculated on what? Calculated on face value. So 10% of rupees 100, that will be equal to rupees 10. So it will be earning rupees 10 each and every year. The person who paid for the bond is going to earn rupees 10 each and every year for the next 5 years. And also on the maturity, the person is eligible to get the face value of the bond, that is rupees 100. So in the 5th year, the person will be earning rupees 10 as well as rupees 100. So if you look closely, this particular portion is forming what? This particular part is forming what? This is forming annuity. Rupees 10, a fixed amount at regular interval. It is forming an annuity, right? Okay. So for this component, we are to earn the present value of interest factor of annuity. Present value of interest factor of annuity. And for this component, we are to calculate the PVIF, that is the present value of interest factor. Are we clear at this particular point? I just told you that bond is being issued at face value, right? Bond being issued at the face value, and the investor will be earning the coupon upon it. And coupon is calculated on the face value only, right? So for each and every year, the person will be earning the coupon. And at the maturity of the bond, the person will also be eligible so as to get the interest component, so as to get the face value of the bond, right? So that's being done, right? And I just told you that the coupon payments which are being done, that's forming an annuity. So for that particular annuity, we have to calculate the PVIFA factor. And for the face value that the person is going to get at the end of the tenor, we have to calculate the PVIF factor, right? That will be useful when we have to value the bond. Okay. Now let's come back to the basics. So I told you about the face value. I told you about the face value. I told you about the coupon. All right. I told you about the maturity value that the person will be getting at the maturity of the bond, maturity value. And further, it's a redemption value. That's the value that you get at the maturity of the bond. That's also called the redemption value, right? So that's the important terminology, right? So if I'm to calculate the total value of the bond, let's say if I'm to calculate the value of the bond for today, now we have to discount these all cash flows. We have to calculate all these cash flows, whatsoever the cash flows that we are getting, we have to discount all those values, right? So let's assume that the discount rate in the market is 12%. We are just assuming that the required rate of return or discounting rate in the market is 12%, right? Most probably in the questions they will be asking the required rate of return is mentioned. They'll be saying required rate of return is mentioned, right? So we are considering it to be 12%. So how will be calculating? I told you that the coupons are forming a annuity, right? In the complete structure, we just learned that the coupons are forming a annuity, and the value that the bond holder is getting at the end of the tenor, that is one part. Okay, so for coupons, we have to calculate the PVIFA factor. We have to calculate the PVIFA factor, right? And for the face value, we have to calculate the PVIF factor. That's it. That you need to memorize. Now, what will be the value of the bond? Or we can say present value of the bond. That will be equal to coupon amount that will be getting each and every year or every month, whatsoever the scenario is, multiplied by PVIFA factor. PVIFA factor. KD percentage is a required rate of return and N is a tenor, right? Plus you're also getting the face value. So that will be the face value, or we say it to be par value. And it is PVIF factor that we need to calculate for the KD percentage. That is the required rate of return and N. That's it. Now I'm just going to fill the values. Coupon we are earning each and every year rupees 10. So it is 10. PVIFA that we need to calculate. KD percentage that I told you, discount rate or the required rate of return, it is a 12%. And N is basically 5 years. The tenor of the bond is 5 years. Just mentioning the values as it is. Face value is rupees 100. And PVIF we need to calculate. KD percentage is 12% and tenor is 5. Right? Now, how we can calculate the PVIF and PVIFA value? Let me just tell you. The PVIF value is basically the formula for the discount rate, right? Discounting factor. Discounting factor formula is 1 divided by 1 plus R raised to power n, right? So this is a discounting factor formula that we need to calculate for PVIF, present value interest factor. Now in this scenario, R is 12%. So it will be 1 divided by 1.12 raised to power 5. So if we just calculate this on our simple calculator, you just calculated the PVIF factor, means this value. So if you simply calculate this value, it means you have just calculated this value, right? So just solving this value, so it will be 1 divided by 1.12 and now press equal to sign for 5 times. 1, 2, 3, 4, 5. So it is 0.567. So I just calculated the PVIF value, the complete hair value. It came out to be 0.5675. 0.56742. This is the value we calculated. And I haven't touched my calculator after calculating this on simple calculator. And I'll simply be pressing GT button, grand total button. And this will be giving me the PVIFA value. Now, without doing anything, simply pressing the GT button, I calculate the PVIFA value, right? So PVIFA value came out to be what? It came out to be 3.60, right? It came out to be 3.60. Okay, so 3.60 is the value that we calculated for PVIFA. Now PVIFA was to be calculated for the coupon, and for PVIF we calculated for the face value. Is that clear? Are you clear with the concept so far? I know it might be some You might be feeling some difficulty so as to grasp it. But let me tell you, this is the easiest way I can tell you, right? So it is very much easier concept. You just need to pay attention while you are listening, right? And you can easily be solving the question. So we just calculated the PVIF value and the PVIFA value. Clear so far? So now we simply be putting the values in the question. So carrying on from this value from here to here. So it will be 10 into 0.56742. Sorry, PVIF value is 3.60. So it is 3.60477 plus 100 into 0.56742, right? So multiplied by 10, that will be equal to 36 here. And so it will be 36.047 plus 56.74. So just adding them up, 56.74 plus 36.047, that would be equal to 92. So 92 rupees is the present value of the bond. And I know that this is the correct one. Let me just re-explain the complete scenario to you, very much easier to understand. I'm having a bond which is having the maturity of 5 years. I marked it over here, 1, 2, 3, 4, 5. I told you that the coupon rate is mentioned to be 10%. It is always to be calculated upon the face value or the par value. So I'm earning rupees 10 each and every year for the next 5 years. And at the end of the tenure, we are also going to get the face value of the bond, that is rupees 100. Clear so far? Now, I told you the formula that the coupons are forming an annuity. So for coupons, we have to calculate the PVIFA factor. Whereas for the future value, we have to calculate the PVIF factor. And thereafter, I just told you how to calculate the PVIF and PVIFA. PVIF is the not other than but the discounting factor formula, that is 1 divided by 1 plus r raised to power n. I just put the values and it came out to be 0.56742, but I never touched my calculator and I simply pressed GT and that gave me the PVIFA value. That's it, right? So we calculated those values, we filled those values at the right place and we calculated the answer. Now, why I am saying that I already knew that this answer is right? Why I'm saying so? Because there are some theorems related to it. The one theorem is that if your required rate of return is equal to the coupon rate, required rate of return is equal to the coupon rate. That's the first case. In that scenario, your present value would be equal to the face value of the bond. Getting it? Like in the question, if it is given that your coupon rate is 10%, and they also say that the required rate of return is also 10%, it means your face value would be equal to the present value. That will be, let's say it's rupees 100 in this example. So we'll be saying it will be rupees 100 only, right? That's the first case. Second case is, that's our case, let's consider, where we consider the required rate of return is greater than the coupon rate, that the discounting is at higher rate than the coupon rate. Now, in our scenario also, the coupon rate was 12% and the coupon rate was 10% and the required rate of return was 12%. So we can simply be considering what? We can simply be considering that the present value would be lesser than the face value of the bond. Definitely, then this is going to be the true, and definitely that make we just proved it, right? Because your face value was what? Your face value was rupees 100 and the value we just calculated, it is rupees 92, right? So that's proven. And the third point is, if your required rate of return is less than the coupon rate, if that's true, let's say the case that our required rate of return is 8% and your coupon rate is 10%. In that scenario, the present value would be greater than the face value of the bond. You can even be trying to solve the question at your end, right? Like using this particular info, you can be trying to solve the question and you'll be finding that what I'm saying is absolutely true. You'll be getting value above 100 only, right? Is that clear so far? So that we have learned so far. Then after that, it's the callable bonds and the putable bonds. Now, so as to understand the callable bonds and putable bonds, we need to understand first of all about the call and put option. Now, option is actually a derivative instrument. Option is what? It's a derivative instrument. Derivative instruments are those instruments which are not having the value of their own, but their value is arrived from the underlying asset. Value is arrived from the underlying asset. That is said to be what? That is said to be the derivative, right? So option is a derivative which gives you right. Option is a derivative which gives you right so as to execute at some particular price, so as to buy or sell, right? But it's not an obligation, and it's of two types. One, we are having the call option, and the other is we having the put option. One, we are having the call option, and the other we are having the put option. Now the call option gives you right to buy. Call option gives you a right to buy, but it's not an obligation. On the other hand, the put option gives you a right to sell. Again, not an obligation. Let's understand this. Very much important concept. Even in the module C, you're having chapter related to the derivatives, which is very much important to understand, right? So let's learn this concept. Okay, so it's about the options. So let's take the case that you're having the company A, B, C, whose share is floating in the market at rupees 100, right? Its per share price is rupees 100 for now. And there is an option seller which is selling a call option, that the same share can be purchased 1 month from now at rupees 130. And for this, he is charging a option premium of rupees 5 per share. Now, what does it indicate? It indicates that rupees 130 would be the strike price at which the option can be executed, that it's a strike price. And the amount which is paid as a commission, as a premium, that's the premium amount that the person has paid, right? And call option gives you what? Call option gives you a right to buy, but not an obligation. It's not an obligation, right? Now, let's assume the case. First case is that after 1 month, the spot rate in the market is rupees 90. The price dropped. It's rupees 90. Now, is this condition favorable? In the market, you can buy at rupees 90. And if you were to buy from the option seller, you can buy it from rupees 130, because option seller option was 130 rupees. The strike price was 130 rupees. So this is not favorable. I'm simply saying it's not favorable. Why? Why it's not favorable? Because in the market, I can be buying at rupees 90. Why would I be buying at rupees 130? Right? So it's not favorable. And whensoever the options are not favorable, these are said to be OTM. What we say them to be? We say them to be OTM. That is out of money. Not considerable. Now, the second scenario we are considering, that let's say the spot rate became after 1 month rupees 150. It became rupees 150, right? Again, the strike price is still rupees 130. The strike price is rupees 130. Now, what does it indicate? It indicates that the market price is at rupees 150, but I can still be buying. I'm having the option. I'm having the right to buy it from the option seller for rupees 130. That's the execution price, strike price. So definitely it's favorable, because in the market I'm getting at higher price, whereas I'm having the right to buy it lower price. So it's favorable. And whenever the options are favorable, we say them to be ITM. That is in the money, right? Now, the third scenario could be related when the spot rate is rupees 130. Now, the strike price is also rupees 130. The spot rate is also rupees 130. So, the case where spot rate becomes equal to the strike price, we declare the scenario as what? As the ATM. ATM is what? ATM is at the money. No profit, no loss situation is ATM. We do not consider the premium amounts while we, distinguish it as ATM, ITM, or OTM. Clear? Right? So that will be the concept related to it. Now, come back to the logic. Now, we were actually learning about the bonds here. Now, you know that a bond can be a callable bond, a bond can be a puttable bond. Now, the callable bond is basically where the issuer is having the right. Now, in this scenario, in the case of the callable bond, the issuer of the bond will be having a right that they can be buying before the maturity period. They can be buying before the maturity period. And in case of the puttable bond, the holder is having the right. So it is issuer's right. Callable bond is issuer's right, and puttable bond is a holder's right. Holder's right so as to sell the bond, because put option gives you right to sell, call option gives you right to buy. So puttable bond basically is a holder's right, where the holder is having an option that he can sell the bond before the maturity, right? So that's about the puttable bond and the callable bonds. After that, it's related to the current yield of the bond. Very important concept again. So what do you mean by the current yield of bond? So let me just give you one other important point related to the bonds, that bond prices are inversely proportional to the interest rates. So if the interest rates increase, the bond prices will fall. If the interest rates decrease, the bond prices will gain or increase, right? So for the current yield is basically, it tells us the annual return that investor is going to earn based upon the bond's current market price. So when we are considering the current yield now, we are not going to consider the fact that what amount you are earning on the face value. As I told you that you are having the rupees 100 bond and 10% coupon for 5 years period, right? So in that scenario, this is the 100 rupees is the what? 100 rupees is a face value. That's not the current market price. I calculated the current market price in the question to be around rupees 92. If you remember, just in the previous example, we solved it na. Rupees 92 was a current market price that we calculated, right? So now it means what? It means current yield is what? Current yield is that what annual coupon interest I'm earning on the current market price. That's it. So it is 10 divided by 92 into 100. That's percentage. So this will be your current yield. 10 is a coupon amount and 92 rupees is the current market price. That's it. So this makes sense. So 10 divided by 92 into 100. So we are earning interest of current yield of 10.86%. So this is the current yield. Are we clear? Right? So current yield can be at par, it can be at premium, it can be at discount. Now, current yield is, if the current yield is greater than the coupon rate, then it is at premium. Now, in this scenario, definitely it's at premium. If it is lesser than the coupon rate, it's at discount. If it is equal to the coupon rate, it's at par, right? So that's about the current yield of the bond. Now, after that, it's about the YTM. YTM is what? YTM is a yield to maturity. YTM is a yield to maturity. So we can say YTM is that particular discount rate. We can say YTM is what? YTM is a discount rate. What kind of discount rate? YTM is a discount rate which converts the present value of the bond equal to the current market price. which converts the present value of the bond to the current market price. That particular required rate of return is set to be what? It is set to be the YTM, that is yield to maturity. Or in other simple language, you can say YTM is the total expected return that an investor earns if bond is held till maturity. If a bond is held till maturity, whatsoever the total expected return that you can be having, that is the YTM. Or conceptually, I just told you what is YTM. It is a discount rate at which your present value of the bond becomes equal to the current market price. That's your YTM. Are we clear with that? Kindly please confirm. And here is a very important formula for this. This is C plus F minus P divided by N and F plus P divided by 2. Now C is what? C is the annual coupon, right? This is the annual coupon interest. I'm just writing over here. Otherwise, you can be solving it using the hit and trial method. So this is the annual coupon interest and F is the face value. F is going to be the face value of the bond, right? And C is the, P is the current market price. P is the current market price of the bond. And N is the years to maturity. Capital N is the years to maturity. Small n is the years to maturity, right? So let's just assume that if F is equal to, basically, let's assume some values. Like we calculated, like C is the coupon. Let's say coupon we calculated to be 10%. In the previous scenario, we considered to be 10%, right? So we can say what coupon will be earning, what coupon, annual coupon interest that we are going to earn. Let's say bond value is rupees 100, face value is rupees 100, 10% coupon for 5 years, and current market price is 92, right? So these are the values we are having as per the question we solved. So what is the annual interest that we'll be having? It is 10, and further F is basically what? Your face value, that is 100, and P is the current market price, that is 92, and divided by N, that is years to maturity, that is 5, right? And divided by F plus P again, that is 100 plus 92 divided by 5. This is what we need to solve. This is what we need to solve. So it is 10 plus 8, 8 plus 8 divided by 5, 1.6. So it is 11.6, and 192 divided by 5, that is 38.4 into 100%. So 11.6 divided by 38.4%, that is 30.20%. This is YTM percentage, right? Are we clear so far? Kindly please confirm. Right. Now, after that, it's related to duration. Again, very important concept. It's about the duration of the bond. Now, duration of the bond tells us what? That if you hold this particular bond for this duration, there will be no interest rate risk. In that scenario, there will be no interest rate risk. So duration is that particular period for which if you hold the bond, then there will be no interest rate risk, right? So the concept is said to be Macaulay duration because it was given by Macaulay. So we say it to be Macaulay duration, or simply we say it to be duration, and it is in years, and it is calculated as sigma PV dot T divided by sigma PV. In denominator, we are having the present value of the bond. In denominator, we are having the present value of the bond, and in the numerator, we have to solve it. So this is the formula related to duration. How we can be solving the duration? Let me just give you some simple example related to it. Let's see the case we are having a bond and we are going to solve it for duration. Let me write over here. Let's just solve a simple question based upon it. It's very much simple to calculate, and it could be like a 3 to 5 mark question that in the exam may be asked. So let's say we are having rupees 1000 bond where the coupon rate is 8%, and it is for, let's say, 5 years or 4 years, right? And the required rate of return is given to be 6%, and we have to calculate the duration of the bond. Now if something this like come up, you have to form a table, right? In the first scenario you have to write the cash flows. So this will be the cash flow, this is the time, right? So the A will be the time, B is the cash flow, and C is the discounting factor that we have to calculate, and D would be the present value, right? And E would be equal to A into D. That's it. We have to calculate five these values. For time, it's of 4 years, so it will be 1, 2, 3, and 4. Cash flow for the first year it would be, because it's earning a coupon of 8%, so it will be rupees 80 for the first year, second 80, third 80, and for fourth year you'll be earning rupees 80 as well as rupees 1000, so it will be 1080, right? Discounting factor formula, if you memorize, I just told you above also for the PVIF, it is 1 divided by 1 plus r raised to power n. So we'll be calculating it and we'll be writing it. Very much easier to calculate and write. So it will be 1 divided by 1 plus r means 8%, 1.08 raised to power n, right? So it is 1 divided by 1.08 for first year. So it will be 1 divided by 1.08 for first year, that is 0.926, 0.926. For second year, 0.857 or 86, 0.79, 0.74, and also for this we can say 0.93, right? Now, so as to calculate the present value, we have to multiply B with D. We have to multiply B with D, that's it. So it is 80 multiplied by 0.93, that's 74.4. 0.86 multiplied by 80, that's 68.8. 0.79 multiplied by 80, that is 63.2. And 1080 multiplied by 0.74, that is 799.2. Now we have to sum them up all, right? So 799.2 plus 63.2 plus 68.8 plus 74.4. So this is a present value, that is 1005.6. This is the present value of the bond, right? That we calculated 1005.6. Now we have to multiply A with D. So 74.4 into 1, that is 74.4. 68.8 into 2, that is 137.6. 63.2 into 3, that is 189.6. And 799.2 multiplied by 4, that's 3196. 3196.8. So we'll be adding them up all, 189.6 plus 137.6 plus 74.4, that is 3598.4. So E is basically nothing other than PV dot T, right? So this is summation of PV and this is summation of PV dot T. So in what was the formula for the duration? It is sigma PV dot T divided by summation of PV. That was the formula. So 3598.4 divided by 1005.6. 1005.6. So duration is 3.57 years. So we just calculated. So the duration of the bond came out to be 3.57 years, right? Are you clear with this? Kindly confirm. यहाँ तक का सारा पॉइंट क्लियर हो गया? काइंडली कंफर्म द सेम। यहां तक का सारा पॉइंट क्लियर हो गया आपको? Right? So that's basically the duration that we calculated. Now there is one other concept related to the same thing. That is the modified duration. That is a modified. Whenever the question will come, na, it will be like you are given with the duration and you have to calculate the modified duration. Or let's say it is a case study, then you have to calculate the duration and the modified duration, right? So something like that. So modified duration is duration divided by 1 plus R. Now R is basically YTM divided by capital M, small m, right? Now in this scenario, YTM is given to be what? It is given to be 6%. Required rate of return is 6%. So YTM is given to be 6%, right? 6% in decimal, that is 0.06. And further divided by N. N is basically compounding. It's yearly or half yearly. It's yearly, so it is 1. If it is half yearly, then it will be 2, right? So R is equal to 0.06. So duration we calculated 3.57 divided by 1.06. So it came out to be 3.375. This is your modified duration. And why the concept of modified duration is important? Why this is important? Why it is even required, right? Why it is even required? The point is that, let's say case, this tells us about the sensitivity. This tells us about the sensitivity. So if the percentage changes by 1%, if the interest rate changes by 1%, right, then the price change would be equal to this one. So price sensitivity is given by percentage in price sensitivity. Let's say percentage change in price of the bond would be equal to what? Modified duration multiplied by the percentage change in YTM. Let's say if the YTM changed by 1%, YTM changed by 1%. So it will be 1% and multiplied by modified duration, that is 3.375. Now in that scenario, percentage change in price would be equal to 3.375%. What does it indicate? It indicates, let's say previous YTM was, we just know it was 6% and now it became 7%. Now there is increase by 1%. Plus one increase ho gaya. There is increase by 1%. Okay. Now in that scenario, I told you already that if there is increase in percentage, if the interest rates increase, the bond prices do fall. So there will be no decrease in bond price. Bond price was previously 1005 somewhat, right? Now it will decrease. Now it will decrease. By what percentage? By this percentage, right? So what I'll be doing? What will be the new present value? It will be equal to 1005 minus 3.375%. So it is 1005 minus 3.375%, that is 971.08. This will be the new present value. So this is the application related to the duration. So what question will be asked? Like you'll be asked to calculate the present value of the bond, you'll be asked to calculate the duration of the bond, you'll be asked to calculate the modified duration of the bond, you'll be asked to calculate the price elasticity, or you'll be asked to calculate the percentage change in price, or you'll be asked to calculate the present value, new present value of the bond, right? So such questions will be asked to you related to the duration and the modified duration, right? So we have covered all these concepts for this case, and tomorrow we'll be covering it related to the principles and practices of banking. Make sure to download this PDF, and if you want to download this PDF, simply just do write JAIIB update and WhatsApp it to the number 83609 and I'll be sharing the details with you, right? So thank you so much and see you again in the next video. Happy learning.